how they are different from other financial securities. What is the difference between REITs and InvITs? We have small and medium REITs also, how small and medium REITs is different from REITs. Further in InvITs, we have private InvITs and public InvITs. So what are these two products and what is the difference between these two products?
So if I have to compare this instrument with other forms of investments, be it equity or debt, this is one instrument which gives you the benefits of both the instruments. So all this time, the capital market in India had equity or fixed income. Now, of course, fixed income had different contours. So you had fixed income through mutual funds, you had debt security investments, you had fixed deposit, all of them giving you a fixed rate of return. Or on the other hand, you had equity, which is of course a risk return mix. If the company is performing accordingly, stock prices move up, capital appreciation is a large part of the gains you make through your equity investments. So this is an instrument which gives you regular income. Under the REIT regulations, we are supposed to give distributions every 6 months, but today most of the REIT InvITs are making quarterly distributions. Generally, REITs have been giving 6 to 7% distribution yield annually. And then because this instrument have underlying assets in form of real estate assets or infra assets, there is also an element of growth. Real estate assets are backed by long-term contracts. So say for example, we have an office which we have lent out. Now this will be backed by a long-term tenure contract with large technology companies. There are inbuilt escalations in the contract, largely match the inflation. So if you look at a long-term basis, we've seen about anywhere between 6 to 8% growth in the rentals, which keeps coming year on year. And this growth in the rentals either translates to the distribution yields moving up. In total, if you look at regular distributions which come to the investors plus the growth, over the last 5 years that the REITs have been into existence, there has been, I would say, a return of about anywhere between 12 to 14%. Then I would say this is one product which is giving a mix of regular income plus growth. And that is one key distinguishing factor between this instrument and the other forms of investment. And
broadly, these are the categories of classification on REITs, real estate assets, InvITs, infrastructure projects. Within InvITs, you have public and private InvITs. And then the third category, which is SM REIT, small and medium scale. On the REITs side, the underlying asset, these are real estate projects. I mean, real estate spanning across commercial, office spaces, retail malls, maybe residential eventually that we may come across. The underlying assets are infrastructure assets and infrastructure which is specified in the harmonized list. This harmonized list of infrastructure is published by the Ministry of Finance. And simplistically put, I think infrastructure projects which have been awarded on a PPP basis, public-private partnership basis, which has definite concession period in which the assets are operated and managed by private developers or even government developers for that matter. Public InvITs and private InvITs, which was another minor differentiation, which was, and again, I think that was more from the standpoint of ensuring that, the initial exposure from an investor standpoint is an informed decision across the infrastructure assets where people understand how these assets operate, what are the kind of business risks which are being posed. So as far as public InvITs are concerned, they are very much like publicly listed company, wherein you have at least 25% of public shareholding. There, the lot size is equivalent to an equity share. Like you can buy one equity share of a company on the listed market. Very similarly, you can also buy one unit of a publicly listed InvIT. There is one more classification, which is privately listed InvITs. Again, these trade on the exchanges, just that instead of it being exactly like a publicly listed company, you only need minimum 5 investors. And the lot size there, from a liquidity standpoint, the lot size there is higher. Right now, it has been about 25 lakhs as the lot size. So somebody who is able to invest at least 25 lakhs at one go is able to trade on the private InvITs side. More or less, the regulations across InvITs and REITs are pretty similar, barring a few, specifically in terms of leverage for that matter. As far as the leverage cap subject to certain conditions are concerned, the cap is slightly higher on the InvIT side versus on the REITs. REITs is about 49%. On the InvITs, cap is 70%, subject to the InvIT being AAA rated. and certain other conditions in terms of disclosures, in terms of minimum distributions, track record, so on and so forth. Quite recently, small and medium REITs, SM REITs, was introduced in the space, and I think that was essentially thought about in terms of providing a framework to regulate and formalize fractional ownership platforms in the real estate market. Within the real estate market, between asset sizes of 50 crores at the minimum and 500 crores at the maximum, there is a significant opportunity between this asset size which is possible to get monetized, and which is why SM REIT as a construct and as platforms were formalized by SEBI. This enables participation by the retail investors along with the institutional investors, and the regulations largely revolve around that, wherein the minimum investors on the SM REITs need to be at least 200. So that essentially enables a very diversified set of investment coming through on the SM REIT, to ensure that only again informed investors who've studied it also takes participation in it. The lot size, or the initial lot size, has been kept at around 10 lakh of rupees.